There's some big insider buying happening at Nike. So the question is, should we be following that insider buying into purchasing the security? Well, that's what I'm going to dive into in this video. So guys, smash that like button, subscribe if you're new, and if you're one of the cats that follows the channel, drop a meow in the chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this one's very interesting because Nike's a very strong brand with a very strong balance sheet heading into a consumer-led recession. And so it's very interesting and it speaks volumes that there's insiders putting big money into buying up the securities in this environment. And what exactly am I talking about? Well, you can see here, Nike's director, John Rogers, has just spent approximately $1 million in buying up the shares in an environment where results can be pressured in the near term with a potential led consumer slowdown. And here's where the article explains that. You can see I've highlighted Rogers paid $1 million on June 30th for 10,000 Nike shares at an average price of approximately $103 per share. And this is on top of the 1,000 shares that he bought in April of 2020 for $78 per share. And so he keeps buying up the shares of this company. And so what exactly is happening at Nike? Well, Nike is an iconic brand in America and globally. But the interesting thing that's happening with the company is that they're revitalizing the company and focusing on one specific sales channel, which is the direct-to-consumer growth channel. So, for example, when you log on to their investor relations sort of webpage, you can see here, you see right away that they're telling you that Nike is a growth company. And essentially, I think what they're going after is a premium growth valuation. And so why exactly are they saying that they're a growth company? They've been around so long. You would think that footwear market is pretty much entrenched. You're not growing at, double digits for Nike products, or are you, And so you can see the way Nike is expected to continue to generate revenue growth is that they're doubling down on their direct-to-consumer strategy by, of course, opening new stores like Jordan standalone stores, which I think is a cool thing. But you're also seeing Nike standalone stores in malls as well. And the direct-to-consumer channel in the online space is growing as well. And of course, you can imagine that that would impact other retailers considerably. One name that the value investing community is very hot on right now is Foot Locker. And if you guys recall, the reason why the value investing community is very hot on Foot Locker, in February, Foot Locker shares actually declined 36% as Nike ramped up selling directly to consumers. And so essentially what's happening is Nike is focusing more on direct to consumer. And so retailers such as Foot Locker will have to find a new way to draw customers into their stores, especially in situations where there's Nike stores in the same mall. And so here's where the rubber hits the road. What I'm going to show you next is sort of how I'm valuing Nike with the model that the Patreons get access to. And it gets a little bit complicated, but I will walk you through it. So this is the model that the Patreons get access to. So on the top right, I just want you to know that there's a couple of ways to look at Nike. I understand that I went into a lot of detail in modeling this company, but I believe that it deserves the respect. And so one of the ways to model the company is by product type. This is the way that we probably would have historically looked at Nike. So footwear, apparel, equipment, Converse, and other. The other way to look at the company, and this is the newer way, and it's the way that I recommend forecasting it, is by sales channel. And the reason why I believe that looking at the company based on sales channel is so important is because management is focused on growing revenue by sales channel. So I think it's the best way to forecast results. So you can see highlighted in yellow right across the revenue ties for both ways to sort of look at the company, either by product type or by sales channel. And that is by design. But notice in the red box highlighted is the sales through direct to consumer. Notice that their strategy is working. This segment is growing fast. So in the double digits every year. And even in fiscal year 2022, where we expected a little bit of a consumer slowdown, they still grew at 15%. But the one thing that I do want you to be aware of is despite this segment growing at double digits, note the bottom line, the revenue line highlighted in yellow. Note how overall the company's revenues have really just been growing in the single digit area, sort of like the high single digit. And so when it comes to forecasting out their results, that's exactly how I'm going to be forecasting it. So you can see that with my 5-year forecast, although I'm forecasting their direct-to-consumer channel to grow in that low double-digit area, notice that overall their revenue is growing in that high single-digit area. And the reason for that is because the sales to wholesale customers are still a big part of the overall business, and that's not growing as fast. Now, the one thing that I do want to point out is that if you're going to go direct to consumers, you're essentially taking the full margin. So you're not giving away any margin to wholesalers. So by you doubling down on the direct to consumer market, I would expect that your gross profit margins would go higher. At least that's what I would think, but that's not what we're seeing here. You can see the push to digital plus the push to direct to consumer has not resulted with higher gross profit margins. So it's actually difficult to forecast higher profitability until I start seeing evidence of this materializing. So effectively what I'm saying here is that there is some upside to my valuation that I haven't really booked in, and this is what some of the analysts might be booking in. And so what exactly do I think the company is worth? Well, you can see that using a terminal multiple of 22 times earnings, I'm valuing the company at around $76 per share. The current share price of the company is $103 per share. So I think the share price as a percentage to the valuation is a little bit high. I believe that Nike is sort of like appropriate value to slightly overvalued. There isn't enough of a margin of safety for me at the current share price. However, I would be interested in this company at anywhere under sort of $40 per share. It might be a pipe dream for it to come down that low, but I'm okay with sort of missing this opportunity if the shares don't come that low. But I do believe that there's an opportunity for that to happen, as once again, I do personally believe that we're heading into a consumer-led recession. Now, if you want access to the model that I've shown you and all of the other models that the Patreons get access to, you can get access to that at the lower tier of the Patreon membership. Now, if you want to join me for a live presentation every month where I save my absolute best work for you, can get access to that at the upper tier of the Patreon membership. And like I always say, if you try it out and you decide that it's not for you, no problem. I'll fully refund your first month's subscription because that's how much I believe in the product. Now, the other thing that I do want to point out is I did mention a couple of times in this video that we are, in my opinion, heading into a consumer-led recession. Well, Michael Burry has actually been predicting that as well. And he actually went further and predicted what's referred to as a bullwhip effect. And I think it's very important as an investor to understand exactly what that is. And I dive into that right here.